Thank you for joining us today. My name is Stuart Hunsicker. I'm with Purpose Driven Retirement Planners. And today we are going to go through the FERS employee retirement benefits. So we're going to cover all the different pieces involved in that program for you. This is my information. All of my contact information, should you need to reach me here, is at the bottom. It'll also be at the bottom of each of the slides as we go through. And I'm happy to help on a one-to-one basis. Any questions you may have. In fact, what we're going to do is we are going to cover all of the benefits uh, eligible that you're eligible for at the what I like to call the 10,000 foot level today. However, it is a bit like drinking from a fire hose. So if you would like a one-to-one session to kind of go through your benefits specifically and how your retirement income will work, how the health insurance and FEGLI and things like that work, we do offer that. No cost or obligation to it. You just go to calendly.com/PDRP, and I am more than happy to meet with you and kind of go through your benefits with you. We'll even create a little financial plan for you. So again, no cost or obligation to that. But again, today we are going to cover everything at the 10,000 foot level, as I like to call it, really just how the programs work. Um, Please understand that all the information that we are going to share today is not to be considered as financial advice because each of you have different circumstances, goals, objectives, things like that. And so the only way to be able to give you advice is to really know your whole picture. So again, today, not financial advice, but just 10,000 foot level of how everything kind of works for you. So the topics we're going to cover, the FERS pension annuity. We'll touch on surviving spouse benefit options, FEGLI, the thrift savings plan, Social Security. We'll touch on Medicare, uh, the FEHB or federal health benefits, long-term care, and then just taxation of how this stuff works in retirement for you. So a little bit of backdrop here. The CSRS system was the original federal retirement system. Today, again, we are covering FERS, but so you understand kind of when they come into play and which one is applicable to you. If you were hired from 1984 or after, you're going to be in the FERS system. If you were hired full time before that, there's a decent chance you're in the CSRS system. Which, if that's the case, unfortunately, this session is not going to apply to you. But feel free to reach out to me directly. I'm happy to go through it on a one-to-one basis with you. But again, 1984 or after is going to be the FERS system, and so that's what we're going to go through today. So defined benefit pension plans, that's what the FERS system is. They all generally are run off of three main factors. So it's usually your service time times an average pay times a percentage. Now for you guys, it is going to be your credible service times your high three salary times a percentage multiplier, which we'll touch on each of these pieces as we go through. So credible service for you all, it involves your civilian service time plus any military service time that you may buy, plus any unused sick leave. So you all have what they call SCD dates. There's actually two different ones. You have a retire SCD date and a leave SCD date. The one that's going to be on your pay stub, it's generally located towards the top. That is known as your leave SCD. And for most of you, it is the same date as your retire SCD. However, if you had any gaps of employment, maybe leave of absences where it was more than what was covered by your leave time, um, or sick leave or anything like that, then technically your retire SCD may in fact be different than your leave SCD. HR can pull your retire SCD. It is also available on your benefits website. It should be listed as either RSCD or retire SCD. That's the date they're going to use to start the calculation for your pension in terms of what your credible service time is. And so your service will run from that date, whatever that date is, up until your last day of work. And so what they're going to do is they're going to take that number. They are going to add to it your unused sick leave. So they base the sick leave on a 2,087 hour work year. It breaks down to just short of 6 hours per day. And so what you'll see is that, um, for 6 hours you get 1 day of credit. 12 hours is 2 days of credit. However, 17 hours is 3 days of credit. So it doesn't quite equal out. It actually ends up being about 5.89 hours makes up a day towards your retirement calculation. So you'll see here that we're referencing 1,000 hours. So we're going to do a little walkthrough on how this is all calculated for you. So let's say your retirement date is December 10th of 2024, and your hire date was February 9th of 1994. Well, what they're going to do is they're going to start with that and they're going to line it out. It's 30 years, 10 months, and 1 day of work time. Then they're going to, in this example, we said, hey, this is a former military individual who had 4 years and you purchased that time. So 4 years even. They kind of line that across, and then they're going to add in your unused sick leave. So in this example, we're using 1,000 hours. Well, 1,000 hours equates to 5 months and 23 days of sick time. So what they do is they'll again line them up, add them all together, and so that equals 35 years, 3 months, and 24 days. They're going to pay you for years and months, but they're going to drop the days and hours. So it's important to kind of keep track of this, but usually when you kind of get in that last month or two before you're ready to retire, you can usually get a pretty good sense of how this is going to unfold for you based on your projected retirement date, at which time you may end up with a few extra hours or maybe even a day or two that you're going to want to utilize. Otherwise, it will get lost. But before then, you don't really need to go through that exercise because you can always shift your retirement date, or who knows, you may get sick between the time you're doing the calculations and the time you actually retire. So when they go to calculate your pension, when OPM sits down to calculate it, they're going to look at all of the time that they have listed on file for you, and this time comes from your SF50 forms. And so we highly recommend that you keep a physical copy of all of your SF50 forms. This is anytime you basically change roles, um, new positions, new locations, there would be an SF50 form generated. You're going to want to get a hold of those and have a copy. um, I know it sounds a little funny that you'd ever have to prove your work history to your employer, but when OPM goes to do your retirement paperwork or your retirement calculations, they're going to use what they have on file. And OPM is located physically in a cave in Boyers, Pennsylvania, and does a lot of their work on paper files still. So uh, human error can come into play here, and so every once in a while there is a situation where they don't necessarily have the correct records, or all of the records for employees. And so if you have your SF50 forms, you can easily prove to them when you worked, how long you worked, where you were, and they'll run the calculations correctly for you. But they do put the onus on you as the employee to prove what they have on file is not accurate. So if you don't have these, there is you have an electronic OPM file, EOPM file, that you can pull them from. You could also go back to your HR departments of the various stops, and they should be able to pull them for you as well. But definitely something you're going to want to get a hold of before you even going into the stages of filling out retirement paperwork. You want to make sure that you have these things handy just in case. Best day to retire. We get this question quite often. Essentially, what happens is your annuity computation is going to start on the first day of the next month following your retirement. So your best bet is to try to retire towards the end of the month. Now, here it's going to say the last day of the month. You really, again, are going to want to take into consideration how many days of sick leave you have or hours of sick leave you have. So it may not exactly be the last day of the month, but certainly within the last, 5 to 8 days. And so if you think into the time frame, what that does for you is, let's say, for example, you want to retire at the end of a year, and say in December. Well, if you retire, let's say the December 30th, you're going to get your next check is going to be the last of your regular paychecks, which should come about midway through January. And then right around February 1st is when you're going to receive that first pension check. So they will still fall relatively close in line with what you're used to. When pension checks kick in, though, they are no longer biweekly, they are monthly. So it's important to keep that in mind. But if you were to retire at the, say, beginning of December, it still could be that your first pension check isn't until February 1st. So you could end up with an entire month or so gap there between getting paid. And so that's why we encourage to be towards the end of a month. Now, I used December as an example here. Um, Note that that is probably the most popular month of all the various months for retirement. And there's a couple of reasons for that. Taxes is one of the implications with it. Holidays obviously play a role in that as well. So just keep that in mind. If you do want to retire in December, get your paperwork in early so you're not like way down the list for OPM to give to you. And generally speaking, you do want to have you probably want to request your retirement paperwork about 90 days out from when you intend to leave. Uh, Sometimes HR will get it to you right away. Sometimes they do drag their feet a little bit, but you definitely want to make sure that it's submitted within 60 days of when you want to retire so that all of your stuff can be processed properly and you don't end up having a delay in your paychecks coming through. So we talked about service time. So the next factor here is high three salary. Now, your high three salary is, I know it says here 3 consecutive years. They don't have to be calendar years. So it's not starting January 1st to December 31st. It's literally the highest 36-month window of time you have as an employee. And so there could be a portion where maybe you've got eight months at one rate, maybe you got 15 months at another rate, and then the remaining months at a third rate. That's fine. They're going to literally multiply those out for that 36-month window and then divide to get a kind of an annual average there for you. So one of the things that I should have mentioned earlier, I always encourage folks when you go through this process and you're planning out your retirement, um, really think through what you want retirement to look like. And I don't mean just, how much do you need to pay the bills, but like to be able to enjoy retirement, whether that's, traveling to a beach or, retiring to the lake or the mountains. And you'll see I wear my retirement shirt to kind of get you in the mood for thinking through this. But really, think about what your goals and aspirations are for retirement so that you can enjoy that time and reap the rewards of the work that you've put in for your entire life. And so I say that because I find that a lot of the folks that I meet with have never really thought through that and figured out, what that income needs to look like, whether it's the same level of income they're used to having coming in, or maybe it's a different number because you want to travel more or maybe travel less. A lot of times people tell me they're going to downsize in retirement or move to a different state. So these are things you want to consider as you go through this process of figuring out your retirement estimates. Because probably the most common question I get in retirement is, or as people plan for retirement is, am I okay? Can I retire? Do I have enough? Right? And those it really is dictated by what that goal is. So it's a little bit different way to think about it, but uh, I encourage you to do that. And that's something that I could certainly help you with on a one-to-one basis to think through that exercise a little bit. But anyway, sorry for the diversion there, but it's definitely important to do, and I forgot to mention it earlier. So now, circling back to your high three salary, we talked about how they calculate it. What's included in it is going to be basic pay plus any locality pay that may be associated with your area. Some of you have that. It's usually on your leave and earnings statement, and it's going to be up towards the top. And some of you have it broken out into two pieces where it'll say basic plus locality. Some of you, they've kind of merged them together, and you'll see it as one number. Either way, that's the number they're going to use. If there's any postal employees watching this, yours is typically not at the top. It's usually listed towards the left side of your pay stub, and it's kind of how they calculate each of your line items on there. So that's the number they're going to use um, when they go to create your high three average. So now we're going to talk about eligibility for you, and there's three what I like to call checkpoints, if you will, for what they call a full unreduced voluntary retirement. And so under FERS, the first one is what they call minimum retirement age. You may also hear it referred to as MRA with 30 years of service. That's one check mark. So if you hit that category, and for a lot of you, it's going to be somewhere between 56 and 57. We'll touch on that here in a slide in a second. But if you hit that age and you have 30 years of service, big but if you have the 30 years of service, you are eligible to retire at that point with an unreduced pension check. And you'll hear me use pension and annuity interchangeably. Um, it really is a pension, but the federal government calls it an annuity, so that's why they're kind of interchangeable. So if you don't hit that qualification, the next checkpoint, if you will, is age 60 with 20 years of service. So again, you have to have both. But if you have both of those, then that also makes you eligible for a full unreduced benefit. Then finally, the third one here is age 62 with 5 years of service. So anything from 62 on, as soon as you hit 5 years of service, you are eligible then for a monthly check should you retire. Now that MRA, the minimum retirement age, you'll see here is based on your birth year. So if you're born before 1948, then MRA is 55. But if you see over here the other extreme, if you were born after 1970 or after, your age is 57. So, find your birth year and make note of your MRA. You may already be aware of that, but that is that minimum retirement age for you, plus the 30 years of service to get a full unreduced benefit. So I mentioned full. There is also the option to do what's called early out voluntary retirement. You also have some, RIF retirement eligibility. So early out, you just need to hit that minimum retirement age with 10 years of service, and you do qualify for a reduced annuity. The reason it's reduced, or the way to calculate the reduction, is they'll first start by taking again your service time times that high three times your the 1%. And so 1% is kind of your factor in this particular case. And so they're going to multiply those out and they're going to get a benefit. And then once they've calculated that benefit, it's a 5% reduction for each year that you're short of age 62. So if you were retiring at, say, 57, you'd be 5 years short of 62. So 5 years times 5% is 25%. So your benefit would be reduced by 25% there. And I think we have another slide on that as well. But keep that in mind when you consider that. So there are other options which we'll touch on as we go through here. But that's one option for you. Age 50 with 20 years of service is another early out for you. And then any age with 25 years of service allows for that. Now, there is also the chance that your employer could come to you and offer you an early retirement because they're maybe downsizing a department, closing a department, whatever it may be. In that case, typically what they do is they'll waive the age requirement for retirement. Now, that's not guaranteed, so you want to make sure that if they are offering that to you, that they are agreeing to waive that age requirement, because otherwise you will be subject to that penalty reduction. So important to keep that in mind. So retirement eligibility here, I mentioned 62 with 5 years of service. Um, you do also have that MRA with 10 years as an option. You'll see here it's also reduced. Disability retirement can be any age with 25 years of service to qualify. Now, I do want to, there are other qualifications that will qualify for disability retirement as well. However, note that how your benefit is calculated is going to be a little bit different depending on how old you are and how many years of service you have. But in order to file for disability retirement, they do require you to at least apply for Social Security disability. You don't have to wait till you get approved, but you do have to apply. Then you can apply for the disability retirement for FERS. They do review them independently of each other. And so, you can get approved for one, but maybe not get approved for Social Security. That's okay. But they do require you to at least apply. And the reason is that your disability benefit is not disability insurance. I do want to make sure that that's clear. Your disability benefit is calculated and then it can be offset by some of that Social Security disability benefit that you receive. And so it's a little bit different offset in your first year versus subsequent years after that. Disability insurance, that is, if you were to get hurt, injured on the job, something like that, and you had to miss some 3, 6 months, whatever, during recovery. Unfortunately, federal employees do not have disability insurance provided by the federal government. So if that's something that's of interest to you, you do need to obtain that on the outside marketplace. That's not something that they offer. If that is you and you fall into that category and you want to know more about that, definitely reach out to me. I can, get you information on that. But just be aware that disability insurance and disability retirement are two different things. Special provision officers. So this is going to be law enforcement officers, or LEOs as they're referred to, firefighters, air traffic control. Uh, Voluntary retirement can be done as early as age 50 with 20 years of service, or any age with 25 years of service. Mandatory retirement is age for LEOs and firefighters is age 57 with 20 years of service. Air traffic control 56 with 20 years of service. Now, I do want to point out that these are the general rules. There are certainly some exceptions to the rule. For example, air traffic control, when they're referring to this dynamic, it's in the chair. So your calculations are based on what they call good time service or in the chair service. You could also potentially take on a management role and extend how long you stay. Um, Really, what it comes down to is getting out of that that specific position. For LEOs and firefighters, they want you to get out of the field, so to speak. So there are some exceptions to the rule there as well. Um, Depending on, it's sort of case by case, but generally speaking, these are the mandatory out ages. So the next thing we're going to touch on here is, what you contribute to the annuity and how those are calculated. So under FERS, the federal government designed this to be a three-part retirement system that you'll hear it referred to a lot of times as a three-legged stool. And so part one is the FERS annuity. The second part is Social Security. Now, this is different than somebody who before you was on CSRS who wasn't Social Security eligible. You all under FERS pay into Social Security, so you will get Social Security as well. And then part three is going to be the TSP plan. And under FERS, not only are you eligible for TSP, but there is a matching contribution, which we'll dive into as well. So that makes up the three parts as the federal government kind of designed the plan. So if you ever hear the three-legged stool, that's what they're talking about. So your annuity contributions, kind of the history of how this works. So CSRS employees contributed 7% of their pay into the pension system. They did not, however, contribute to Social Security and thus were not eligible for Social Security. That's why their benefit multipliers were a little bit higher. You've probably heard that before. But there's pros and cons to to whether their plan was better or worse than yours, right? Well, when they switched over, and the reason they switched was Social Security was struggling, didn't have enough money to stay relevant at that time, and so when they dropped back and kind of evaluated how do we fix Social Security, the answer was to get more people contributing to it, and the federal government was probably the largest group of employees that by far that didn't contribute to Social Security. So what they did is they created the FERS system. And so they started out with FERS. It was a still 7% of your pay that came out, but 6.2% went to Social Security and 0.8% went into your FERS annuity. And this stayed in place for quite a bit of time. And then in the about 2013, they their actuaries for the pension system came to them and said, "Hey, uh, we're not getting enough money from the employees to sustain the benefits that we're promising them. So we have to increase how much they're contributing, honestly, and how much the federal government was contributing to the plan because it was short funded." So they then went from the 0.8% to 3.1%. Still a good deal, but they kept that in place for about a year. And then they realized they still didn't have enough going in. So they then bumped it to where it currently sits, which is 4.4%. So anybody hired after 2014, it's 4.4% that goes into the annuity and 6.2 for Social Security for a total of 10.6% that comes out of your paycheck. When you look at your pay stub, you'll see this listed as either FERS or it may say retire. Um, and that's usually the 4.4 amount or the zero point 0.8 amount on your check or the 3.1. And then usually over on the kind of the side next to it, you'll see OASDI. That is your Social Security contribution going in. Now, again, special provision employees, that's air traffic control, LEOs, firefighters, 7.5% of your pay comes out. It's 1.3% for the annuity and 6.2 for Social Security. So let's loop back to the calculation for FERS. You heard me mention earlier that it's the high three salary times your total years of service. And so if you're retiring under age 62 or age 62 with less than 20 years of service, then the multiplier is 1% uh, per year, basically. And so the way this works, as an example is, let's say you were 60 with 20 years of service and you're retiring. Well, it's going to be 20 years times that average high three salary times 1%. Now, if you are age 62 with 20 years of service, so again, you have to be 62 and you have to have at least 20 years of service to count for this. And I'll explain a little bit more in a minute as to why that is, but you have to have both. But if you have both, there's actually a 10% increase in your multiplier. So instead of 1%, it's 1.1. The rest of the formula is the same. Now, under the FERS annuity with the MRA plus 10, again, they're going to calculate it the same way we just saw, but they're going to penalize you 5%. You see right here, 5% for each year you're under age 62. So if you're 60 with 10 years, you get it reduced by for 2 years, so 10%. If you're 58 in doing this with 10 years, then you'd be, say, 4 years short, so that'd be 20% reduction. Um, so that can be a big hit. Now, you do have other options. So let's say, for example, you want to retire at 58 with your 10 years, but you're just going to go do something different, right? You want to get out of the federal employment. And so you're okay not getting that pension check right away because you're going to go do something different. Well, you can defer that payment. So you can defer the annuity payment until 62, and that will avoid the reduction. So the way that would work is you just say, hey, don't pay me from 58 to 62, but when I get to 62, I want to start getting the check. They are happy to do that, and you won't get that 20% reduction in the example. So they'll pay you the full benefit for your 10 years of service, right? However, if you do that, you do want to be aware that your FEHB, your health, and FEGLI get suspended until that age 62, at which time you'll have the option to renew them. So I mentioned if you went to get another job, as long as that other job's going to give you health insurance, or maybe you have health insurance through military time with TRICARE or through a spouse's job, that's fine. But it's something to consider that if you are on FEHB and you choose this, you are going to lose that FEHB coverage from the time you leave, let's in this example 58, until the time your pension starts back up at 62. So definitely something to kind of keep in mind there. Now, next thing we're going to touch on is called the Special Retirement Supplement, or SRS. So FERS who retire under the age of 62, you won't qualify for Social Security payments until you're 62, because that is 62 is currently the minimum age to start turning on Social Security. We'll touch on it a little bit more later, but you only want to do that if you're not working anywhere else, right? But important to keep in mind. So when they've designed this program to allow you to be rewarded for putting in, a full career, even if you're not, 62 when you say hit that 30-year mark, right? So they created this special retirement supplement. Again, it was originally designed to be an enticement for people to, when they made that transition from CSRS to FERS, to sort of bolster up the FERS system, and encourage you to take advantage of this system instead of the CSRS option. You don't have that option anymore, but they still have kept this system going. It is on the docket for certain political parties want to get rid of this, but as of right now, you do have this. So what happens is, don't be confused, it's not coming from, this money does not come from Social Security. It does involve Social Security in its calculation, but the money comes from OPM. And so let's say, for example, you retire at 57 and you have 30 years of service. They will pay this extra pension check to you from age 57 to age 62, at which time you become Social Security eligible. And then this will stop. Now, it does not mean that you have to take Social Security at 62. They could care less whether you turn it on or not. This check will still stop when you turn 62. The way they calculate it is they take your years of in the FERS system and they divide it by 40. And then they multiply that by what is your age 62 Social Security benefit, projected benefit. So we use a little sample here. So let's say you had 33 years of service. They're going to take 33, divide it by 40. Then they're going to multiply it. In this example, we're saying your Social Security projection was $1,200 for age 62. So 33 divided by 40 times 1,200 equals $990. And that will be paid monthly by OPM until you reach age 62. So this is kind of why they pay that 10% extra if you're 62 with 20 years, because you're not going to get this benefit, but you're going to get 10% extra on the regular calculation. So it's kind of a trade-off. Hopefully that makes sense, but certainly you can let us know if you have questions on it. Now, special provisions annuity calculations is what we're going to jump into next. So air traffic controllers, you are 1.7% times that high three for the first 20 years of service that you have. And then anything over 20 years, they're going to give you 1% times the high three for. And again, I mentioned there are some exceptions to that rule for when you retire. Law enforcement officers and firefighters is essentially the same formula: 1.7 times high three for the first 20, plus 1% times the high three for the remaining years. The thing you'll see here, though, is that LEOs can be retained by your agency at their discretion up until the age of 60. So that's why I said there are some exceptions to the rule to that required mandatory retirement age that we saw earlier. So the next thing we're going to talk about is survivorship, surviving spouse benefit options. So at retirement, you, the employee, are going to make a survivor benefit election. That's right on your application. And so it is a permanent election for the most part. The only time you could change it is if you chose your spouse as a beneficiary and your spouse were to predecease you, they will go back and adjust it after that. But when you retire, you're going to have three choices. The first one is no survivor benefit, which means you get the full unreduced annuity payout. Second one is a 25% survivor benefit. And the third option is a 50% survivor benefit option. Now, the cost to the 25% is a 5% benefit reduction to you. For the 50% spousal option, it is a 10% benefit reduction. Now, one thing to keep in mind here, and I'll give you sort of some math examples of this, is that the benefit, so let's use 50% survivor option. The 50% is based off of the original calculation amount. So let's say you, as the federal employee, you have $1,000 a month benefit as when you run through the calculation, and you want to do a 50% survivor. Well, it's going to cost you 10% to do it. So instead of you getting $1,000 a month, you're going to get 900, so 10% less, and you'll get that for life. But if you predecease your spouse is going to get 50% of the unreduced original amount. So in this example, it was $1,000. So they're going to get 50% of that 1,000. So they're going to get $500 a month for the rest of their life. So that's how it works. There are certainly pros and cons to each option there. One of the things to consider is to it's not just about the money. So if your spouse is going to be on FEHB with you into retirement, and they need to keep it no matter what. So if you predecease them, they're going to need to stay on the health insurance. Then they have to be at least a 25% beneficiary on the pension, or they'll lose that payout option. So important to keep that in mind. I typically recommend, if that's the case, you do the 50%. And the reason is that the premium for the health insurance comes out of the annuity payout. They won't allow it to come out of a checking account or anything like that. So you want to make sure that there's enough in that benefit to pay the health insurance cost. So this slide here talks about insurable interest survivor benefits. So someone other than your spouse, right? Or like if you don't have a spouse, right? You can name someone else. However, there are some specific rules to it. It can be any relative who's closer than a first cousin, but it has to be financially dependent on the retiree. It does exclude children, but it can include a domestic partner or former spouse. So kind of important to keep that in mind. The second caveat is you need to look at how old that other individual is in comparison to your age. So if the difference between you two is less than 5 years, then the cost to do that option is a 10% reduction, just like a spouse would be. However, if it's more than a 5 year age differential between the two of you, then the cost could be as much as 40%. It depends on that spread, right? If this applies to you, I definitely suggest meeting with us, meeting with a financial planner, somebody to walk through the different options that you have, because as you can see, 40% reduction in your benefit is a lot to leave a potential benefit to somebody. So definitely something to consider there. Now, this is what I mentioned earlier. If your surviving spouse is not doesn't need FEHB, then it doesn't, it's not as big of a deal to not have them listed as a beneficiary, because you could certainly replace income and other, with other assets or even with life insurance. But if they need to have FEHB, should you predecease them, then they need to, again, be at least a 25% beneficiary on the actual FEHB or FERS pension. So once you've retired, you are subject to receiving what are called COLA, or cost of living adjustments. So they start at the age of 62. So even though you may retire at 57, 58, 60, doesn't matter. The COLAs won't kick in until at least 62. And they are based on the Consumer Price Index, or CPI. And so if CPI comes in for the year between 0 and 2%, you're going to get that full percentage applied as your COLA. If if CPI comes in between 2% and 3%, then you're going to get 2% as your COLA adjustment. And if CPI comes in over 3%, you get that CPI number less 1%. So you'll hear some people talk about this as like Diet Cola or Cola Light. And the reason is, again, it doesn't exactly match CPI. When you think CPI, think inflation. It tends to be kind of the same metric that they use to adjust Social Security benefits over time. So if there's no survivor, you have no survivor benefit elected. Where this comes into play is that with your pension, when you retire, they start paying you back those first, couple of years of checks are money you put in the system. Um, it pays you back your money first. Then after that period, the money that's paid out is actually from the federal government side, their contributions. So if you were to, what this slide's referring to is if you were to pass away in, say, the first 2 or 3 years of retirement, there still would be something that you had contributed that hadn't yet paid out, and therefore it would pay out to a beneficiary, even though you may not have a beneficiary listed. So, uh, or may not have taken the beneficiary option. So if you have a spouse, it's typically going to pay to your spouse. If no spouse, it then usually goes to children in equal shares, followed by parents, executors, next of kin. So it kind of works down this order of precedence, right? And so again, this is only if something were to happen to you in those first couple of years of retirement, where you technically had money that had not been distributed out to you yet. Beyond about, I'd say 5 years is probably a safe mark. Anything past about 5 years, if you don't have a survivor benefit option elected, there's not going to be any payout going to your beneficiaries past that.